on a deal that you're looking at, like if you're standing to make 7 figures on a deal and you gave up like 5, maybe 6 figures to know that you don't want to work with this person long term, like I kind of consider that an investment. I'd be willing to pay that to know who I don't want to work with in the future sometimes. And so I think you have to kind of look at it like that is not every deal is going to work out perfectly. Not everything is going to be as you thought it was. But if you spend time dwelling on that, that's taking up time and energy and effort that I would rather spend on figuring out how to make that back somewhere else.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How's it going, bud?
We're rolling. We're doing good. We're hanging in there. We have a property selling tomorrow. Nice. We got nothing to buy. And I was going for a run this morning and I fell and cut my whole hand because it snowed a shit ton and there's ice everywhere. But other than that, we're doing good.
As long as you weren't like, that famous clip where it's like the two people running in New York City and they're like, this is the perfect weather to run. It's cushiony. And then you see them panning by and she just absolutely slips on her ass. As long as that wasn't you, as long as you didn't brag about it beforehand, I think you're in the clear.
No, we were, I was actually on the phone and someone said to me that was actually borderline shocking that actually came out of their mouth. So it like caught me off guard. And then I went, head over heels and I caught myself, but I cut myself. But I think the person has like a ring or a nest. So I'm going to go in to see if someone has a picture of me busting my ass. But we're doing good.
Exactly. We'll have you go viral on Barstool or something else. And, maybe you'll pick up some followers yourself. They'll come back. Maybe that's how you make it big time.
Exactly.
Love it. But let's jump into today's episode. We're a little bit short on time, but I also just want to get right into it because we were talking beforehand and just going really well. And, I think it's going to be an interesting conversation. So very excited to have her on and hear her story. So with that being said, Veena, thank you so much for joining us.
Thanks for having me here. I'm really excited to be here. And I'm glad that I don't live in cold weather anymore. I grew up in Chicago and I do not miss the winters.
Yes. Yeah. Well, I just moved from Florida. So I chose a really good year to miss out on the winter in New York because the past couple of years were not nearly as bad as it has been. So I'm kind of sitting here laughing right now, but I'm sure the tables will be turned in a few months when I'm just an absolute puddle in the office every day.
Yeah, I live in Dallas now, so I get that too.
I hear you. But awesome. Can you kick us off, tell everybody listening a little bit about you, your background, your journey, and what you do?
Yeah, so my name is Veena Jetti. I am the founder of a company called Vive Funds. I'm a large multifamily owner-operator syndicator based out of Dallas, Texas. And right now, I'm currently in the Texas, Florida, and Georgia markets. We have about $400 million in our portfolio across various assets, looking to expand this year. I'm adding a few more markets that I've been studying very closely that I'm looking forward to expanding into if I can find a deal. But we look for Class B value add multifamily assets, go in, renovate, typically a 5-year hold, targeting, double-digit returns for our investors, similar to other syndicators in the space. So that's kind of what we do in a nutshell.
Awesome. Take us back a little bit, just because I always love to hear the context and people's journey very quickly. How did you get to where you are today and what you're doing?
Yeah, I always tell people I totally took the shortcut in because I come from a real estate family. So my mom is actually a very successful real estate investor. Both my parents retired early from their real estate investments. Now they actually have their money invested with me. So we've kind of moved to the next generation. And so I graduated college with my degree in finance when I was 20 years old, thought I was going to do something revolutionary, told my parents I wasn't working for the family business, went out and got a job in corporate real estate. So made a lot of money for somebody else. The first year my husband and I paid joint taxes, I called my mom and was like, what is happening right now? We just paid multiple 6 figures in taxes. She's like, yeah, you should be working for yourself, not a W-2. So left my corporate gig where I was on the management team of a $1 billion asset there in DC, left there to go out on my own and start my own company. And, that was in 2012. And it's 2021 now. So almost a decade ago.
Gotcha. Love that. And what was it like? Because I'm always curious just going through it myself. And I think a lot of people would love to make that transition as well. What was that like for you making that decision? Like, I'm sure it wasn't just, oh, we don't want to pay a buttload in taxes, to go from, obviously what sounded like a very healthy income to potentially going to no income, what sounds like overnight. How did you have the confidence to make that jump?
Wow, I don't know if anybody ever has the confidence to actually make that jump. Sometimes you just got to do it and see what happens, right? I think, I'm actually very lucky because like my husband has a pretty stable income. So for me, I had that safety net. And like in my mind, I was like, okay, well, if everything goes to shit, then I'm just going to move in with my parents and be an adult who's married, living with my parents. Like that was my plan in my mind the whole time.
Mm-hmm.
Spoiler alert, I didn't have to do that. So
Great. Yeah, no, I think it's interesting because I kind of had the same thought process when I spoke with people and was like, all right, you go off on your own worst case scenario. Like, you have people or places to fall back on, or you just go get another job. I know that's easier said than done, right? You can be in a really bad economy or whatever, but I don't know. I think, maybe it takes extra work, but you can always fall back on going and working for somebody else if it doesn't work, or pivoting into something else. So I love that you said, the confidence piece isn't necessarily there, but, for me, it was looking at it and I said, all right, do I want to be 80 years old and not have done it and live in regret? Or do I go out and try it? And, again, what's really the worst case scenario? There's other ways to do things.
I totally agree. I think focusing on kind of what's the worst case scenario, because I actually did that a lot when I was like in my earlier 20s, mid 20s. I would think about it like, okay, so I can afford to lose every single dollar I have today, and I can build it back. I know that now because the experience I have now is what's going to get me there. So, people always say like the first million is the hardest to make. I finally understood, like just like 2 years ago, why people say that. Mm-hmm. It's not because it's hard to make $1 million, or it's easy to make $1 million after the first million, and it's really hard the first million. It's because once you know how to make money, you can continue making money. So going from like 0 to 1 million was absolutely the hardest, right? But then going from like 1 to 2 was a lot easier, and then 2 to 4 is a lot easier. So that's actually what they meant. And I never understood why they said that, but now I get it, because once you know how to make money, you can continue making money.
I've spoken to some very confident people and people that have listened to our show and know me. I'm as confident as it gets. Now, luckily for me, or unluckily, depending on how you look at it, I never had a job where I got paid. My life from day one has always been an eat what you kill sales type role. So when I decided to go full time, I didn't know what it was like to have this stability. So I had no expectations except for, well, I've always been able to do it. I'll be able to do it. But you speak to very confident people, and I think the way you looked at it, worst case scenario, I'm moving back in with my parents and I can figure it out. I've spoken to very confident people who still, they're back of the envelope, pen and paper and Excel spreadsheets. Like, okay, if this happens, because they don't have that confidence to actually cut off the income and then go forward. Now, yes, having safety nets like moving in with your parents, and I lived with my parents when I first started, or having a husband or a partner that has a good income, that obviously helps. But I think people have to hear that no matter how confident you are, it's still not a decision that's easy to make, understanding that you don't know what's going to happen. So people don't have to think that it's a level of confidence that you have to do it. People just have to understand that when you do it, you just got to commit to it and do it. And that's what inevitably makes people successful, is when they go through the process and replicate it over and over and over again.
And I think like entrepreneurship, like success is like, it's not because we do whatever business operations we do, right? It's because we pivot and we solve problems. Like that's really what we do. And I think if you can solve a problem, even in no business, I don't care which entrepreneur you talk to, nobody who's been in business long enough has not had failures or setbacks or bumps in the road along the way, right? Like we've all had that. It's how you pivot around it and how you work around it that is actually what's crucial and important. And I think especially in real estate, being able to pivot and revisit strategies often is very important.
Mm-hmm. Yeah, I know, we were talking about this on one of the other episodes. When I moved down here, I thought I was going to do some wholesaling on the side as well, just as like a short-term revenue boost. Because I bought a 16-unit property and I'm trying to buy small to mid-sized stuff, build up the management arm, and go from there as well to be vertically integrated day one. And I was like, managing 16 units isn't going to take me 50 hours a week. It's, 2-3 hours a week. So I was like, okay, what else am I going to do? And spent some money, even bought a small course just to I was like, okay, have a little bit of money, spend money as a learning curve. And now I'm just like, screw that. I don't want to do it. But it's not viewing it as like the $5,000 to $10,000 I've spent as I've lost. It's over. It's $5,000 to $10,000 viewing it as, okay, I realize I don't want to do this, but how do we take what we've learned or pivot or do something else that is going to, fill whatever that was supposed to be. And I think that is tough for a lot of people, kind of looking at that, not going, okay, that's, $5,000, $7,000 in the red that I'm never going to get back. For me, it's okay. We'll make it back in 6 months, 9 months, 12 months, 2 days, whatever it is. And, we'll just kind of figure it out.
Yeah, I absolutely agree. And I actually view things, sometimes I view sunk costs as very cheap lessons because I've done the expensive lessons before and the cheap ones are much better. And so I'll kind of give you an example that recently came up in a business partnership that we were kind of talking about. We had someone come in who we gave a agreement to or a deal to or whatnot. And ultimately, it didn't really end up kind of how we thought it would. And the contribution from the other person wasn't really what we thought it was going to be. And, that happens, right? Like not everybody is going to work to the same work ethic that I'm willing to work to. And one of my other partners approached me saying, like, I'm so sorry. Like, this was my fault. I brought this person into the fold. And now we've spent, an extra 5, 6, whatever figures, giving up what portion we agreed to give to them. And I said, listen, on a deal that you're looking at, like if you're standing to make 7 figures on a deal and you gave up like 5, maybe 6 figures to know that you don't want to work with this person long term, like I kind of consider that an investment. I'd be willing to pay that to know who I don't want to work with in the future sometimes. And so I think you have to kind of look at it like that is not every deal is going to work out perfectly. Not everything is going to be as you thought it was. But if you spend time dwelling on that, that's taking up time and energy and effort that I would rather spend on figuring out how to make that back somewhere else. So
I think that is so important for people to hear because people, structuring a deal, whatever type of deal it is, a wholesale to a super large multifamily or whatever, people don't realize that the cost or the opportunity that you give up, it's a very, glass half empty way to look at it. It's like, look how much we gave up. That was my fault. It's, look at it the other way. That structure sucked. Let's never do that again. / well, we just paid for a lesson that is better to learn than to do so much more. And I think that's that's why I would look at it. I've done some stupid shit. But it's not, okay, I lost money on this. It didn't work out. But if you do the same mistake again, shame on you. But if you do it once and learn, well, that could be the best dollars you've ever spent because it's going to catapult you into success knowing that, well, I'm not doing that again. If it gets proposed, it's a no. It's an automatic no. So, that lesson learned, if someone took one thing away from this and who knows where the rest of the podcast is going, that in itself, realizing that, your opportunity cost and the dollars you spend educating and learning may be big, but at the end of the day, it's such a small price over the course of a 20, 30, 40-year career that it could be the best decision you made. So you can't cry over spilt milk. You got to realize, let's focus intentions on earning that back and not making it again.
That's exactly how I look at it. Like you hit the nail on the head. And I told the person who was feeling guilty, I was like, listen, you shouldn't feel guilty because I'm not mad about this. I would have paid $50,000 or $100,000 to know that I want to do business with you and not with somebody else. So
100%.
Yeah, I love that. And you talked about something too before we got on, and it was just small. You were talking about your schedule and your admin helping you out and stuff. And I think it kind of relates to kind of what we're just talking about in a slightly different way, but basically like investing in people and freeing up your time. Is that something that you're really big on?
Yeah, I do this actually a whole lot in my domestic life at home, which I'm sure I get judged for all the time, but I really do not care. Anything in my house that can be done for like 15 or 20 bucks an hour or less, I outsource it.
Like what?
For everything, literally everything. I buy my vegetables pre-chopped. I buy meal kits. I order in food when I need to. I have my housekeepers come. They do my laundry. I just recently have help now 5 nights a week where they clean my kitchen and my family room. And I have nannies that take care of my kids. I outsource everything. So when I'm with my kids, I get to do the fun stuff. I don't have to worry about like taking out the diaper pail and folding their clothes. I don't do any of that. When I'm with my kids, we play, we do ring around the rosy, we do all the fun stuff. We do bath time together, but I work hard enough that I can afford to outsource those things. I have an admin in my company. My sister is a minority partner in the company. And so I'm like a total control freak. And so it's really hard for me to give up control. Mm-hmm. But the one thing like I cannot relinquish is access and control to bank accounts. I can't do it. And so I am a glutton for punishment. We distribute to our investors on a monthly basis. So you're looking at the person who does all 500 plus distributions every month. But my sister is the only other person who has access to the bank accounts, or any partners on the deal can have access to the bank account, and that's it. But as far as admin goes, theoretically, she schedules for me. I'm really terrible at like not putting stuff on my calendar when someone reaches out to me. I have to get better at that. I'm trying. And, we have we have an asset manager, we have different roles that come in depending on the deal. We kind of package together the team there.
Gotcha. I love that. Yeah. Cause it's something that I've realized a lot. And like, as I came down here, me managing 16 units is not a good source of my time. Mm-hmm. But the reason I chose to do it was to get educated on things I didn't know. So in that way, it is actually a really good source of my time. Because I have to go tomorrow to pick up a check that got returned to sender for some reason to my office that didn't. So I have to go pick that up. I have to go meet, with the flooring guy. I have to go meet with the plumber to like discuss all this stuff. And that's not stuff that I should be doing as we're going through renovations, but it is really important, especially in the short term, for me to learn. But it is something that I'm quickly looking to hire somebody else because now because we're doing renovations, the 5 hours, the 7 hours I'm spending every week, instead of making $15 an hour, I can pay somebody for that once we have a little bit more scale, allow me to focus on finding new deals, start looking at investors, doing alternative things that are going to bring in a lot more money. And it's a really tricky balance. And I'm sure you go through it as well. As money does come in, okay, what do I utilize this for? Do I utilize this for people? Do I utilize this for business? Do I invest it in the business? Do I invest it in real estate? So like, how do you, as you are making money, revenues coming in, how do you decide what you're going to spend money on?
Yeah, so I actually prioritize investor experience. So for me, that's like kind of the holy grail of what my company is built on. So I invest into portals and I invest into, anything that makes their lives easier. So like if it's an e-sign software, or if it's a MailChimp platform, or my portal actually sends out my updates now. My admin is client facing. So that's actually where I prioritize my funds because I want them to have like that white glove experience. I always like to say I want to be like the Chanel of real estate syndications. Mm-hmm. And that's kind of what I go for. And that's what I want my investors to kind of know and experience. And, because that's the lifeblood of my company. It's everything has to be done in their best interest. Otherwise, I'm doing one deal and I'm never doing another deal again. Mm-hmm. But the KPI I focus on within my company is actually not how many investors or anything like that. It's actually how many investors invest in 2 or more deals of mine. That's what I care about the most. I want that as close to 100% as possible all the time. And so right now I'm at I'm probably now closer to like 70-75%, but that's because I just did a really big raise. So I got a lot of new investors that just haven't had the opportunity to invest into new deals. But before that, I would say it would be around 80, 85, 90% of my investors are in 2 or more deals. And that's what's important to me.
I love that. I think that's a really great way to look at it. Is there anything that you think you do differently than other people, or just you pay a ton of attention to, that you think separates yourself from other people or positions yourself as that white glove service that you think is really good?
Yeah, I think it's the access. My investors can always call me, text me, email me, whatever they need to do. And they're really great about being respectful of like, okay, if this is a scheduling question, they know to email my admin versus me, because as we said before, they may or may not get double or triple booked if I'm scheduling it.
Sure.
But they're very good about that. If they have something that's a little bit of a longer discussion, they call me or schedule a call with me, or if it's a quick question, they'll send me a text. So they're really great about it. But I actually pride myself on communication with my investors. And an interesting thing. So I feel like no one ever talks about the things they did wrong, right? And so
you do a good job at that.
I'd love to kind of like point out like big misstep that I had during COVID, because I don't think people are talking about this now. And I think this is how we learn and we become better, right? And to what John said earlier, you can make a mistake once. You can't keep making the same mistake again, right? So back during COVID, I had an asset in Florida that we were actually listing for sale. And we rolled it out, and then like 2 seconds later, the whole country shut down. And we were like, okay, well, like now what? Normally when something goes wrong, I'd like be like, hey mom, this just happened. Or I'd call like one of my colleagues or friends from one of my corporate careers, or someone who knows more than I do, which is a lot of people. And so but I didn't know who to call. No one knew what to do. No one knew what this meant. So we were definitely like kind of stumbling over our feet there. And the problem at that time was there was so much information coming out, like every 2 seconds, it was changing. And so I would get a sentence out and it would be completely different. And so there was a hesitation to put information out and have it be bad. So what we did instead was I immediately called a conference call between investors on that asset about 5 weeks into the pandemic. And I just said, hey guys, like, this is the state of the union. This is what's happening. This is what's going on with the sale. We're not fire selling it. We're also not pulling it, but we got a lot of low ball offers because people thought we were fire selling it. It just happened to be coincidental timing. Mm-hmm. And so ultimately, I got a lot of calls after that call from investors and, oh my gosh, am I losing all my money? And I was like, no, like, we're not even concerned about principal loss right now. We paused pref because we're hoarding cash. We're managing cash like very tight at the asset level. And I was like, but no, you're not losing your principal. Like, we have no concern about that right now at all. Like, the asset hasn't lost value. We're still cash flowing. We probably could have realistically, hindsight being 2020, paid out pref or some amount of pref. We just wanted to be more conservative. And so I got like 4, 5, 6 phone calls after that call. And I was like, okay, obviously the message did not get across well. And so what I actually started doing is I started implementing a monthly update. So now my standard process is anytime we are making a sudden change in pro forma or just something unusual out of the ordinary, I send out communication to investors. So we send a monthly email. In that monthly email, I say, hey, listen, there's a change here. We're going to a monthly update call. So now every month on that asset, I think it's the first Thursday of every month, I get on a call. And until we start reestablishing pref, which we just did this last month, I get on a monthly call to walk through, here's the bad debt, here's the what's happening with the moratorium, here's our evictions, here's our skips, I give them kind of the financial overview on a monthly basis. And so the lesson I learned from that, right, is because I pride myself on communication. I knew better and I still didn't do it because of the overload of information I was getting. Mm-hmm. But now I've realized that if I could go back and redo everything, I would have immediately instated a call Depending on how many investors you have, it might be like a one-on-one call or it might be like a conference call webinar. But I immediately put a call on the books. I schedule it for whatever the second, whatever of every month or however you want to do, even if it's a quarterly or every other month call. I think it's important to tell investors, like, you can expect increased communication during this time. And that was a big misstep I made, was not doing that right away. I waited like maybe 4 months before implementing that.
Gotcha. No, I think that's a really good lesson. And I think people can learn from it. Obviously, hopefully the same exact scenario doesn't come up again in, a few years or a dozen years or whatever it is. But I think, in times of uncertainty, because it is so passive in the way it's set up, I think having that communication with investors is definitely important. But it obviously was a crazy time, especially in March and April. It was, we were sitting there, we were running scenarios on deals and we were like, oh my God, we're going to shit the bed and this is going to be awful. And then things just kind of, chugged along a little bit. So yeah, I think it was a weird time. And I think, it speaks to, the great job that you had done up until that point in building rapport, that, people didn't totally freak out if they didn't feel they were getting the communication they were looking for. It was just a call after you finally put something like, basically like, hey, we didn't get enough, but it wasn't like this, this mass, crazy thing that you got afterwards. So I think that's why it's important that, building that up beforehand and really having those relationships carries over. So when something like this happens, because it wasn't just a financial impact, it's also an emotional and personal impact on everybody involved. There is that length of rope that you've built up before you kind of hang yourself. So I think that's really important.
Yeah. And then I hung myself and tried to unhang myself.
Well, you clearly did. So that's good.
Yes. Yeah. I made that recovery, but now I've learned from it. So going back, these are expensive and sometimes painful lessons to learn, but they're absolutely well worth it, because now I don't make that mistake anymore. And you can make a mistake one time and that's it.
Mm-hmm. No, for sure. And I think most people realize too, right? We're going to make mistakes, and anybody who thinks we're not going to make mistakes, or anybody you work with isn't going to make mistakes, is just, I don't know, just on another world. So I think most people understand that, and within reason, can kind of make it work. So that makes sense. But since we're kind of on the subject as well, as we've gone through this process of COVID and things are starting to open back up and, vaccines are rolling out, have you guys changed at all how you're looking at things, doing things going forward?
Yeah. So actually we've been more conservative. So I did exactly one deal last year, but it was a big deal. It was an $80 million deal in Marietta, Georgia. It was 494 units, value add deal. I wish I could find 100 deals like this deal, because it is just, we underwrote it so conservatively, because we initially underwrote it in July. And we were still kind of mid-pandemic. There was no vaccine in sight. And the asset had done really well through March through July. So we obviously liked that, but we underwrote it. We actually took the seller's T12 and we took the NOI down on it. And we actually took it down 7% and said, okay, at a bare minimum, we have to operate at 93% of what the current out-of-state owner is operating at. And we changed assumptions. So, and I'm not sure what you guys are assuming on renovations, et cetera, but we assumed 0 renovations for year 1. We assumed that we were starting in month 13 and going to month 36 or actually 33 for renovations, because 101 units were already renovated. Mm-hmm. We made some very conservative, we adjusted for taxes and insurance. It was interesting though, because on this one, I think it's one of the first times that we've actually adjusted insurance down from the seller's T12, which is unusual, right? Usually you're adjusting it up, but for whatever reason, our insurance quote on our policy was much cheaper than the seller's. So we adjusted to actual numbers. Otherwise, we would have adjusted up. We adjusted our taxes up we actually overshot it by $200,000, which, we had 5 consultants be like, where'd you get this number from? We're like, we don't know. We just kind of took a stab. Here's the math behind it. And then we added a little bit and they're like, no, you're off by $200,000. So, for us, we start out with one version and then we underwrite it a bajillion times between start to finish. We're still underwriting the deal now post-close to make sure that we're tracking to pro forma. And so for me, like those adjustments to underwriting being more conservative is actually better for us. We told our investors, and we always do this, like we wait 90 days post-close during transition before distributing our first check. On this one, we closed October 26th, and they had their first check on Christmas Eve. They've already gotten their second check in January, third check in February. So on a monthly basis, they now get their distributions as well. So things are going very well at that property. We underwrote it at 92% occupancy, and we're hovering pretty steady around 95%. We've seen a 6.6 to 9% increase on lease renewals with no renovation. On new leases, we're seeing up to 15% on some with no renovation there either. So sometimes you want to kind of like keep pushing to get your feet under you and see what the market's going to pay. So that's kind of the phase we're in right now, because we're only 3 months into owning it. But yeah, definitely making different assumptions and different strategic moves.
Gotcha. No, I think that's, what a lot of people are having to do. And I think it's a really good thing to do of, understanding that what it has been doing, especially at that point in time during COVID, was, there's a very real chance that it's not going to continue to do as well, right? If you have increased bad debt, increased concessions to get people in, increase or decrease collections, as you buy a new property, obviously your taxes are going to go up in most areas, depending upon where it is. So, you have to account for all those things. And, there's a very real chance that your NOI is going to go down through this stuff and through the first year, especially if you're going to hold off renovations and, really do it. But I think like a lot of people, pending certain states where restrictions are a lot tighter, a lot of people have seen not a massive impact in their operations. So that's obviously, very exciting to hear for you guys.
Yes. Yeah. One thing we've been really big on is limiting our community events, because you don't want to have like 100 tenants with COVID all spreading with each other at the same party, because you want them to keep working and paying rent. But, we've had very few CDC declarations from this asset that we were talking about in Marietta. It's just a good tenant base. They all were already kind of working from home. And actually by September, before we even closed the deal, the seller's T12 was already reflecting above our year one pro forma, obviously. And we were kind of mid year two on where it was at that moment. But, we planned it with the idea that there could be a second wave of this pandemic. Like there's new strains coming out. We don't really know. And I don't think that's just particular to COVID, right? Like there could be COVID-20 in the future or COVID-21. We just don't know. And we have to plan appropriately.
Yeah, I think it's important, and you talked about something too that I think, especially a lot of newer people don't realize, where you were saying, we were continuing to underwrite and we're continuing to underwrite. I think a lot of people make the poor assumption that like you underwrite a deal and then that's it. And it is what it is. And I laughed because like, even this 16 unit deal I bought, I've pulled up the model and changed it. Probably if there was like a history you could go through, it'd probably take you an hour to scroll through the number of histories in it. We used to do like different versions and we would end up with dozens and dozens of versions. And I just don't want that for myself. So I was like, I'll just change it. And it's just me and my dad. So it's not that big of a deal. But it's like, you're constantly tweaking different things, running scenarios, seeing like, okay, if the taxes are higher than I thought, or if they come in lower, or if I can hit higher rents, or if our occupancy goes higher, those are all things you constantly want to be understanding and staying on top of, because nobody's budget is ever right. That's the other thing too, right? If you put, $1 million in taxes or $10,000 in taxes, almost guaranteed you're going to be wrong. Whether you're wrong by $1 or you're wrong by, $500,000, that happens. And sometimes it's in your benefit and sometimes it's not, but that's part of this game where you put budgets on paper and it's funny because it's never right. Hopefully you do it well enough that you're wrong to the right way, where everything is either higher on the income and lower on the expenses, but it doesn't always work that way.
That's exactly it. You want to overshoot your expense assumptions and undershoot your income assumptions, and you'll be fine.
Yeah, it beats the alternative when it goes the opposite way. That's never a fun conversation.
Yeah, definitely under promise, over deliver. That's got to be the goal.
And I think too, especially when we talk with a lot of people that are limited partners or newer to the space, or probably just don't have as great of an understanding of what's going on. One of the things that I think is not spoken about enough or not understood enough is that you should be paying equally as much attention to different scenarios and sensitivity analysis as you are to what the returns are on paper. Because as we all know, you change a couple numbers and assumptions and it goes from a 12 to a 15 or a 15 to a 20. And it's not that hard to do, but you do want to see if occupancy drops 5%. Well, if one deal goes from a 15 return to a 5 and another one goes from a 15 to a 14, those are two very different deals. And then you need to dig and understand, okay, if that small of a change is, reflecting in my return so much, why is that happening? And do I feel comfortable with that? If that scenario ever does happen, I would encourage everybody to not do that deal. But I was going a little bit extreme just to prove a point. So, understanding, if things change, how much does it affect the deal and the returns I'm expected to get is very important, because things are going to go right or wrong, against you or for you in one way or another. And no deal, very rarely does everything go in your favor, and very rarely does everything go against your favor. Usually it's, you've got some checks on the pro, some checks on the con, unless, once in a while you do step into a deal that everything just magically goes right and some that everything magically goes wrong. But I think
where you see more of the sensitivity analysis actually make a difference is especially on newer operators. I don't know if you guys have seen this, but I've seen a lot of deals where they are going in at, let's say, like a 4.5 or a 5 cap on the deal. And then they're assuming an exit at a 4.5 or a 5 cap on the deal. And I'm like, and to be completely transparent, I actually look at deals like that too, where I set the inbound cap and the exit cap the exact same to keep like kind of an apples to apples comparison. But then we tweak it after that. So it's just like one round where I want to look at it that way. But then the true slice that I look at, we actually add 10 basis points planned year of hold. It's pretty standard. I've seen some people doing like 7 basis points. And look, I think we're in a pretty stable cap rate environment, depending on which markets you're in. I don't really think that there's going to be like a whole point. And historically, there hasn't been, even in 2007, 2008, there hasn't been that much movement in our markets, at least. But you want to know that about your markets, and you want to look at the sensitivity. And the one thing I actually tell investors, like LP investors, is so we have like 4 goals when we invest for LPs, right? First and foremost, at every turn, no matter what, is going to be protecting principal. There's nothing more important than that as like the bare minimum of what we try to do. That's not always going to be possible. There are going to be scenarios where you have a capital call or something happens. We have not capital called our investors, but there are going to be scenarios that happens. No one has the Midas touch, right? Like something is going to happen, but what you're trying to do is minimize the need for the principal to be lost or your shares to be diluted. So that's like the first goal. The second goal is to hit the pref return. So if you're structured with a preferred return, the second goal we have is to hit that 7 or 9, 8, whatever % on the pref return on that project. Third goal is to perform to pro forma and get to the split and the various hurdles that we have set. And the fourth goal, and this is like where we shoot for on all of our deals, is to overperform and go above and beyond whatever the pro forma is. And so I think when investors kind of look at it like that, it becomes a little bit easier to understand your risk profile, because at least for my investors, and you should know your investor avatar, right? Like my investors, they care about it being tax advantage. They care about it being stable. They care about it not being correlated to the market, so to speak. And so they're looking for diversity in their investments. About 70% of my investors are physicians. So they're usually in the market, diversified there, and this is an alternative investment class for them. So my investors look for that, like those things, and then they look for protection of principal, which you don't really get in the market, right? Like you can go from having $100,000 to $20,000 overnight. Or if you're like me and you're gambling and investing into Bitcoin, some days I wake up with like a $45,000 Bitcoin price, and sometimes it's like 27. So.
Yeah, I hear you. No, I think that's hugely important. Everything you just said is great. I know one thing that I had a conversation with my dad on this deal that we did that helped him kind of understand was I always look at, okay, if I've basically got to take a property, if like a complete overhaul and almost redo everything, take it down to the studs and redo it, probably like 50 grand a unit to redo that, which is extreme, right? It's very rare that you're going to have to do that on a deal that's stable and, you know, has been somewhat well maintained, is in a decent area. That's pretty rare that that's going to happen, but that's worst case scenario. And for me, when I was looking at this deal, I said, okay, we bought it for 73. I have a post renovation spending like 15,000 at 125 a door. I said, if we had to spend 50 and our NOI and our rents were exactly the same, I said, we would get all our money back. We would break even. We wouldn't make money. But I said, from a risk reward standpoint, I said, there is a very minutia chance that we're going to have to do all of that. Yeah, you'd have lost income too. I'm not discounting that by any means, but you know, that would be the worst case. And I said, look, we're going to basically break even, right? Okay, maybe you have to spend 55, maybe you have to spend 45. Who really knows, right? But the chance that you would even have to do that is so low. But if something happened that you had to, you would break even. And not only that, if you had to redo all that and you basically created a brand new project in the frame of a 60s built thing, guaranteed you would be able to charge a higher rent as well. It would probably operate even cheaper. So there's also a very good chance that it would be worth more than 125 anyway. And when we kind of had that conversation, you know, it gives you that little bit of a better feel good factor when you start looking at things of that way of like, okay, if this is our worst case scenario, how do we shake out and how do we feel about that? And what are the chances? Luckily in this deal, I felt, you know, very well covered. You don't always get that degree of coverage. I think we just kind of got very lucky on our purchase price, but you know, that kind of, you know, is what it is. So I think those are the ways that, you know, people have to start looking at it of, okay, what to break even, what cap rate do we have to sell it for in 5 years? Is it 6.5, 7, 8? Like, you know, that can make you feel safer. Like, okay, even if we're buying it for a 5 today, if I can sell it for a 7 cap in 5 years and break even, you know, that gives you a decent amount of wiggle room. If it's an 8, a 9, or a 10, I mean, that would be pretty extreme and I'd be pretty surprised in the projects we're talking about. But, you know, it just gives you that greater level of comfort as you look at it. Now, if you look at it and you've got to sell it at a 5.5 cap to break even in 5 years, unless you're in like New York City or Toronto or, you know, some crazy big market where you're buying stuff for 3 caps, you know, you may not feel as confident. So those are kind of things that I encourage people to look for.
I totally agree. And, you know, sometimes we all get lucky and sometimes it's better to be lucky than good sometimes. Right? So every now and then you get this deal that you didn't realize how much of a gem it was until like you're actually in and operating it. And then you're like, oh, this is better. Like I knew I liked it before. Now I like really like it. And I want another deal like this. And you can't ever find that deal ever.
Yeah, I was about to say, you get into it, you're like, why can't they all go like this, right? If they all went like this, I'd be the, you know, the happiest person in the world.
Yeah. Barely have then.
Yeah. You just hope your wins outweigh your losses over time and that you do well. So, because there will be losses. I'm sure we've all had them.
Yes. It's a marathon, not a sprint.
For sure.
I hear you. So what are you guys looking to do going forward in terms of just like, you know, whether it's deals you're looking to do, are you looking to change it all? Is it just, you know, continue the growth? You know, how are you guys viewing things?
Yeah, it's interesting because I feel like this is like kind of a catalyst for change for a lot of companies. We're definitely no exception to that. Obviously, we've moved like to very much tech processes in general, especially with everyone being social distance. So we are looking to expand. So right now we're in Texas, Florida, and Georgia, looking to expand to North Carolina, South Carolina. We've added Phoenix and Vegas to kind of our list that we're looking at. Tampa within Florida is a market we're not in yet, but it's definitely at the top of our list now. So really what we're looking for is those like tier 2 and tier 2 emerging cities that are institutionally investable. One of the things we've been kind of toying with is the idea of maybe doing like a semi-blind fund. Going back to what I was saying though about like being investor first, there are certain limitations on a semi-blind fund that I'm still trying to kind of like navigate. How do I align interests with investors? Because one of the challenges you see on a semi-blind fund is if you take money in, you got to spend it. You can't just leave it there because you're not going to make your returns. And so what I'm trying to mitigate is the risk of taking in that capital. And because like I walk away from deals way more than anybody else in my field. Like other syndicators do I do about 25% of the amount of deals because I'm a very patient and disciplined investor. But then the question becomes, if I have semi-blind capital, how do I make sure that my deal flow is strong enough to support taking in that capital? Is there like some kind of a system where we trigger a capital call at the right time? So we're kind of like working through that and seeing what that looks like. I don't know that we actually roll out with a semi-blind fund, but it's definitely something that we're looking at, exploring. For right now, it's going to be to continue growing in our markets, targeting, those large multifamily assets. We typically like 200 doors and up. We'll look at 150, but it has to be like a really good reason. Like we already own an asset right there that it makes sense and we can exit as an entire portfolio and, generate more income for all investors in our project. So it really just depends, but I'd say like pretty much bread and butter strategy. We are pretty laser focused on what we do. I'm planning on getting slightly dabbling into some mixed use development deals personally, and kind of seeing what that looks like. Because I think that there's going to be a lot of opportunity in new development in the next few years.
Mm-hmm. Is there any reason you're looking at mixed use versus just straight multifamily, especially with everything that's going on with retail currently?
Yeah, so there's actually a specific project that I'm very seriously looking at. It's in Atlanta, or it's actually like a multi-billion-dollar development. And so it's like a big city, and they're essentially like establishing another suburb of Atlanta, and it's like the whole entire block. But the potential developers on that, I know them personally. I really believe in them. They have a great track record. And more importantly, when I invest as an LP, what I look for is, okay, like we've been saying, right? Like things go wrong sometimes. So what I look for is I want to know that the deal, if I lose my money or don't get my return or whatever that is, if things don't go right, I want to know it's not because of the sponsor on the deal being neglectful or not doing what they can or not being involved or kind of not caring about the business after a year or two. Mm-hmm. So for me, that's like paramount because I'm open to market risk. Obviously, it's an investment. Everybody's taking it on. What I'm not open to is somebody taking on a deal, getting an acquisition fee, and then walking away from the deal. Mm-hmm. That's a problem for me. So I really believe in the potential partners on the project. I believe in the vision of the project. I obviously love Atlanta. I'm very invested there now. Mm-hmm. It is a booming area. It's one of 3 markets that has a higher rent today than it did pre-COVID. The other 2 are Philly and Portland, if you're interested to know. It's just a fun fact. Mm-hmm. And so I really like that area. And so I also am invested into a production studio. I don't know if you guys know this, but like Georgia is the new Hollywood. Mm-hmm. And I don't know why it is. And I actually am not even really sure why I decided to invest in this like a year and a half ago when I first invested. So this project is actually mixed use with like a production studio. It's like 5 minutes from a private airport. So, actors, actresses that are coming in can land their private plane there and then get to set in 5 minutes. So I just think the business plan makes sense. So that's how I'm looking at it. I'm totally open to pure multifamily as well.
Gotcha. So when you're looking at the person running the deal and underwriting them and feel confident in it, and then being okay with the market risk, what are some things that you look for in the sponsor that might be helpful for somebody else to incorporate?
Yeah, integrity is like absolutely end all to be all for me. I want to know that they care about the deal just as much as I do. And actually, this one's like a little bit different because I have a lot of LPs that approach me saying like, oh, I don't want to pay fees. Like fees are too high. But I actually don't care what the fees are to the sponsor as long as there are a good amount of fees. And I want to pay those fees because if I'm writing you like $100,000 or $1 million check, I don't want you not making money to look after my money. Like I want you incentivized to do well on this. And I want us aligned in our incentives to do well on this. And so because I look at the returns as net of fees, right? Like anybody that puts out an OM should be putting it out net of fees. So if I say, hey, Chris, this project we have, we're projecting a 15% AAR, 14% IRR. I expect that to be net of my fees, not at a project level IRR, project level returns. It's investor level returns. So for me, if I'm making like 14, 15%, I could do that all day long and be just fine. I'm fine if the sponsor's making 10, 20, 30, 50%, great, because that means that you are more incentivized to look after my project. And so I know it's a little backward and it's not really how most investors look at sponsor fees, but that's how I like to look at them.
No, people love to count other people's money. At the end of the day, I agree. I don't care about paying someone. I want their vision to match the deal's vision so that if something goes wrong, it's not on to the next shiny object and, let this one run its course. It's, I gotta, what do I have to do to turn this thing around or make it work? So it's a battle that everybody has, but at the end of the day, when someone tells me, oh, you're getting paid too much, or this is not working, or I don't like to split, well, then you know what? Invest with somebody else. Because at the end of the day, if I have to justify it, it's probably a relationship that's not going to work. Even if you deliver, they're always going to want more. So I agree with that. It's, people just have to realize that's the cost of doing business. And, you can't go into the supermarket and tell them you don't want to pay that for blueberries because blueberries cost less money. It doesn't work that way.
Exactly. No, that's exactly it. And, I'm actually at a point right now, I overfund all of my deals. So everything I do goes to a waiting list. And again, it's because I do so few deals that my investors are like waiting for my deals to come out. And so I don't actually take all investors anymore. In my intake call, if I don't think they're a good fit for any reason, I just tell them like, hey, probably not a good fit for you. I'm sure there's a billion other syndicators out there.
Just pick somebody else.
Yeah, there's gonna be someone that's a better fit because my strategy or my synergy it doesn't feel right. And because this is a long-term, it's like marrying someone, it's like marrying like 100 people that you don't really know the way you hopefully like know your spouse. And then it's like you're in this relationship for at least like 5 years on average. And it's really going to matter when things get crazy and you're trying to communicate with them. So we were talking about the goodwill earlier. So I think it's like really important to be very methodical about who you're letting invest in your deals too. It's not just like a one-way street. It's a two-way street. It's a relationship.
100%.
No, for sure. I think a ton of people, we've spoken about it before, but it's great to hear you bring it up as well. Because if you are raising money from people, what them interviewing you, it's equally as important for you to interview them and understand, what are their expectations of the project and the relationship? What are they looking for? How much, like what % of their capital are they putting in? Because if somebody's putting in, I don't want to hear that somebody's putting in their last $50,000 into a deal, because that's just a recipe for disaster. All those things are important. And if somebody doesn't want to tell you like, hey, it's 5% or 10%, or, I have X, you're not even going to share that when you're going to, we're talking about, finances and partnering, that's a red flag to me, because that stuff is important because, this is a passive investment. They really don't have a ton of day-to-day say, if any. When things go wrong, it's up to us to make decisions. So, if $50,000 is being tied up for 5 years and having a really tough time accessing it, if something goes wrong, is going to cause problems, that's a potential problem I don't want to be a part of. So, as people start to raise money, they need to understand that it's, it is very much a two-way street, and you don't have to take any dollar that comes across your way, because some dollars have a lot of strings attached to them and you don't want that.
Exactly. Because like I've done that. Like when I was first raising capital and I was like crying myself to sleep every night, not sure if I was going to be able to close the deal. We took a lot of capital in that we were desperate for dollars, right? And I was going to put my own dollars in to bridge any gap at the end of the day. But today we've built up our database, our track record, our customer service experience. And so now we're thankfully not in that position anymore. But yeah, I think that is absolutely crucial. It's got to be a two-way street. It cannot be one way.
Mm-hmm. Yeah. And, none of us are naive that, the first times raising dollars, you're going to have to be a little bit more flexible and, maybe a little bit tougher to turn people away and say no. But if it's like, if it's really big and it like really doesn't feel right and you really think it's going to be a problem, even if it's early, even at the cost of a deal, you're, in my opinion, and everything changes, but you're way better off saying no and walking away from something than potentially having a massive headache. Because I know we've been involved in deals with investors and partners and stuff that causes tremendous headaches down the road. And you're like, losing $20,000, $50,000, $100,000 to not do the deal would have been worth it if I had known this was going to be the problem. So,
right. Yeah. And, actually another thing, and I'm sure you guys see this in the syndication world all the time, is I like to know who I'm dealing with, because there are people that are like GPs on deals that have no control or like no real say in the deal. And that's not who I want to talk to. I want to talk to the person who's making the day-to-day decision. So that's kind of the other thing I would say too is, if you're at the point, or if you aren't at a point where you can turn capital away, be working toward that, but also be cognizant of how your investors are interacting with the people that are actually involved in the deal day to day. That's what you want to kind of know.
100%. Awesome. I think that's a great place to wrap up though. Veena, thank you so much for coming on and sharing everything. I think people got a ton out of it. I know I even picked up a couple things. So thank you very much. But if people want to learn more about you, connect with you, follow you, where can they do all that stuff?
Absolutely. Thanks for having me. This has been actually a really fun conversation. So my website is vivefunds.com, VIVEFUNDS.com. If you want to sign up on my database and we can do an intake call or whatever, there's a portal button there. I'm also on social media. As I said before we started this, I'm really terrible at social media, but I am on Instagram and Twitter, Veena Jetti. I've been using Clubhouse a lot. I don't know if you guys are on there, but a lot. I'm on like all these rooms. I actually answer a lot of questions in there for people that want to get started or passive investors. I kind of speak to everything in the multifamily syndication world. So if you're on there, find me there. I do a lot on there. So.
Awesome. Love it. Guys, definitely go check her out. And if you're not on Clubhouse already, it's kind of exploding a little bit and there's some really good real estate stuff on there. I know John and I are on it as well. I don't do it enough. I do it when I feel like it. I really should be on there more, but it is what it is, right? But definitely go check her out. Definitely go hit her up. And if you are looking for deals, definitely check them out because they have some great ones. But thank you everybody so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Once again, Veena, thank you so much for coming on. This was amazing.
Yes, thanks for having me.